property for even more than $1 million before that 90-day contract expires. And that's what he's betting on. But you know what? What happens to that contract over time? Let's say the start is today. He gives you the $500. You enter into the contract to sell your property to him for $1 million. Now he has the right to buy your property for $1 million, but he's not obligated to do that. So he doesn't have to buy your property for $1 million. Not like a purchase contract like you would when you buy your home, but this is just an option to hold the property and to buy it in a future date for $1 million. So he goes out and he tries to find someone else who is willing to take his contract and purchase your property for $1.2 million. So he's hoping to make a $200,000 profit on that property. If he finds someone who's willing to purchase your home for $1.2 million, he comes and he before the 90 days is up, he tells you, yes, hey, guess what? Hey, I'm going to buy your property for $1 million. And you are ecstatic. You are very, very happy about that. So he buys your property for $1 million. He already has a buyer for $1.2 million. He turns around and sells it to them for $1.2 million, making a $200,000 profit himself. And you have $1 million in your pocket where you can go out and buy another property. But what happens if he can't find a buyer? Well, if we started the contract today and 90 days later it expires, what happens to that contract over time? Well, if the 30 days pass by and he still hasn't found a buyer higher than the purchase price that he's asked you that you'd be willing to sell it for, then the value of that contract should actually go down a little bit. So instead of maybe originally it was worth $500, now maybe it's only worth $450 because 30% of the time has expired, has eroded that contract to the point where now instead of 90 days in which to find a buyer, he only has 60 days in which to find a buyer. So the probabilities of him actually finding a buyer at 90 days was much higher than it is at 60 days. And then let's say another 30 days has gone by and he has still not found a buyer for the property in which he can make a profit. Well, that contract now is worth even less money. Maybe it's only worth $250 because two-thirds of the time, 60 days have passed and he hasn't been able to find a buyer. So the contract that he has entered into with you is now worth less because there's a much lower probability that he is actually going to be able to find a buyer of $1 million or more. Actually, more than $1 million, because if he buys it for $1 million and he can only sell it for $1 million, he's not going to make any money, is he? So he needs to find someone who's willing to buy it for more than $1 million. And now 60 days have passed and he hasn't been able to find anybody. So that little contract that he has, the option to purchase your property, is going to be worth a lot less. Well, in the last 30 days, he still hasn't been able to find a buyer. And guess what? At 90 days after you originally entered into that contract with him, that contract date has expired, and he hasn't found anyone to purchase the property for more than $1 million. But since he paid you a premium $500 and the contract expired, you get to keep that $500, and now you are no longer obligated to sell him the property for $1 million. So that's essentially what happens when you go to buy a call option, an option who is hoping to profit from the price increase of a stock. Let's take it for an example, IBM. And I'm going to go to my screen just for a second, and I'm going to show you what an option contract is selling for IBM. We'll go down here to options. We'll take a look at the current month of options, which is May. Now, remember, option contracts will fluctuate in price and expire at a certain date. Almost all option contracts expire the third week of the month in which they're being written. So the May contracts will expire the third Friday of the month in May. That is the last day that you can trade those contracts. At the close of business on the third Friday of May, you will no longer be able to trade those contracts, and the contracts will expire the very next day. So you're going to, let's take this May of 2008 90 price strike price option. If you were to buy a call option, you would buy it at $34.80. You can also sell a contract. In other words, just like the property owner, even though you do not own the stock, but the market gives you the right to sell a contract on a stock that you do not own. And you could sell that contract for $34.10. So, in other words, you can collect the premium, just like the option buyer who came to your property and gave you a $500 premium. You would collect that $34.10 on that option contract, and you get to keep it as long as the price of IBM goes below $90. Is at $90 or below. That's what makes option trading so much more flexible, because you can both be a writer of options and a buyer of options at the same time. And there's all kinds of strategies that you can use in order to profit not only from the expiration date of these options, but also from the fluctuation in the prices themselves. Most people who are speculators in the market buy what we call at-the-money options. So right now, IBM is trading at $124.40. The closest option to that price is the 125 option. And the 125 option is right now, if you wanted to buy it, it's $2.80. So a single contract, if you were to purchase a call option on IBM at the 125 strike price, you would pay $2.80 for one contract. However, one contract gives you the right to purchase 100 shares of IBM stock. So if you were to purchase one contract, let's just click on that as a buy, and we'll toggle this down to one contract. One contract of the 125 call option on the May expiration of IBM would cost you $280, because you are actually purchasing the right to buy not one share of IBM, but one contract equals 100 shares of IBM. So whatever the price of that option is, $2.80, you would have to multiply by 100 in order to determine your exact cost. So including your commissions of $2.95 for one contract, your total cost is $282.95. Now, how would you determine whether or not you would ever make a profit? Well, if IBM stock rose in price, okay, let's say it went up $5 tomorrow, and that's a distinct possibility, because IBM does move pretty quickly, and it does move in sometimes large numbers. What would the price? How would you determine the price of the contract of the 125 strike price? See, if you purchase one contract of this May 08 125 contract on IBM, that gives you the right to purchase IBM at $125. Okay? The premium that you're paying, the $280 for that one contract, that one option contract that gives you the right to buy 100 shares of IBM, will expire the third week of May, the third Friday of May, to be specific. So right now, you're purchasing the right, but not the obligation to purchase IBM at $125. Now, what happens if you're right and IBM does increase in price? Let's say it goes all the way up to $145. Well, if it's at $145, you as long as it's at $145 before the third Friday